Hi, thank you for joining our mid-year economic and market update. My name is Dave Mantell, and in today's presentation, we'll look back at the first half of the year, as well as our outlook going forward in the second half. So I'll share my screen here and we'll jump into the presentation. So for anybody tuning in, you're very well or likely aware of a recent market volatility that we've experienced at the beginning of August here. And that's a reason we love doing these presentations. As we noted here, knowledge is power, but a step beyond that, having a good understanding and perspective of how the markets work, how your portfolios are designed, how your financial plan is laid out, provides a lot of confidence and context in terms of what's going on. And so we found these are really powerful presentations to provide an update on what we're seeing, which also tends to lead to comfort in your own plan and how we're going to weather these certain stretches. So starting on the more rosy side, looking back, the second quarter turned out to be a very decent quarter in the markets, following a very strong first quarter. It didn't start out that way. April was quite a volatile month as we saw the markets try to understand and digest where we were with interest rates and inflation. In the first quarter of the year, we had very stubborn inflation where we saw it start to tick up actually. And you may recall, as recent as December, January, there was an expectation that we'd have 7 rate cuts in the market this year. Here we are sitting in the summer, in August for that matter, and we haven't had any rate cuts. And so it goes to show that despite inflation staying pretty, resilient and kind of not really going down to the levels the Fed was hoping, and on top of it, the fact that we didn't see any interest rate cuts, it was very positive to see a strong first half of the year with the S&P 500 up 14% and the Dow Jones up 4%. A lot of the breakthrough in the second quarter, moving into May and June, is we did see inflation really moderate, which was a very big deal. So as you can see in this number, June overall inflation lowered down to 3% year over year, a much progress number from what we saw in the earlier months of the year, where at one point we were trending back to 3.5% and increasing. And so this has been a big deal in the market, seeing inflation work its way down, which gives a lot of flexibility for the Fed to ease if needed, to lower interest rates, to stimulate the economy, knowing that there's a much better control on inflation. It's worth noting that 3% inflation is still well over the 2% target that the Fed has set their sights on. But I think the main takeaway here is that 3% inflation is something the Fed can stomach. It's a lot of progress from where we were in the worries of nearly 10% inflation at the peaks not long ago. And so at 3%, it gives access to the full toolkit for the Fed to leverage if we do deal with a slowdown in the economy or the need for some easing. So this has been very strong progress in this regard. Whenever you're talking inflation, interest rates go hand in hand. You can't really talk about one without the other. And as I alluded to earlier, here we are in August and we have had 0 rate cuts for the year. The Fed fund target rate, so short-term interest rate, which the Fed really controls, is at 5.25% to 5.5% still. And so we're still at that elevated level. It'll be interesting to see looking forward if we see rates start to reduce and when. Currently, the expectation is we're going to see half a rate or half a percentage interest rate cut at the September Fed meeting and another cut later in the year by another 0.25%. So that math would take us to 4.75, 4.5 to 4.75%. Still a relatively high rate to what we've seen in recent history. And so nonetheless, at these current interest rate levels, the Fed has a lot of flexibility to ease and really provide some support for the economy by reducing interest rates, which will in turn reduce borrowing costs. So this is something to really keep an eye on. And likely we're getting closer to that point of a Fed rate cut, especially after the recent interest rate inflation progress that we've seen, as noted on that prior chart. So What has been really fascinating is earlier this year, we saw very stubborn bond yields. And what that means is interest rates on bonds stayed at an elevated level, despite the early expectation for a lot of rate cuts. And as makes sense and as expected, as we have seen the Fed keep interest rates where they are, we've also seen bond yields, bond interest rates stay elevated as well. With this recent expectation that the Fed is finally going to cut, we've seen a ton of progress in the last week alone. So the end of July and early August, where interest rates have really started to come down. As you can see, at the end of June, even a 2-year Treasury bond was yielding close to 4.8%. As as of August 2nd, we saw that same 2-year Treasury bond drop all the way down to 3.8%, so a 1% reduction. And this goes around along the curve. And so this has been a really moving target where we've seen a lot of changes in interest rates over time. You know, from our view, this is an area to continue to be opportunistic. For example, 1 month Treasury bills at 5.5% is still very good value in our mind. And yes, we do expect the Fed to cut rates at some point soon, though you could have said the same thing a year ago, right? And since then, we've enjoyed another year of very high interest yield on those short-term bonds. Likewise, 10-year bonds at that 4% or so range, those are about long-term averages, which is pretty refreshing after, 10, 15 years of near 0% interest rates. And so that tends to provide good value. Typically, what you'll see is what's called a more standard yield curve, where short-term bonds will give you a lower yield than longer-term bonds. We have not seen that for quite a while. We're going on essentially 2 years where short-term bonds have continued to provide better yield than long-term bonds. If you take out that 1 month Treasury bill on this chart, we're essentially there where, the 10-year and the 20-year are in line, if not slightly higher than the 2-year bond. And so this is something where we'll continue to look to be opportunistic on. And currently, we see a lot of good value in those real short-term bonds, the Treasury bills, the 1 to 3 month, for example. And then on the longer term, 5 to 10 years, let's call it, we believe that's a decent bang for your buck yield and return, especially because that has some additional benefits of complementing your other portfolio investments. For example, in an environment where stocks will do poorly, generally longer term bonds will do well. Wasn't the case in 2022. But again, it's been a real moving target here and something that we continue to watch. Okay. So now, as we've talked about interest rates, inflation, the number one question on every mind is where does the stock market go from here? And especially with the recent volatility that we've seen, we've got quite a few phone calls asking, is this now a correction? Have we reached that correction? I know we've been due for a while as a time. And so there's a lot of different variables we want to look at. For one, we are in the midst of a very long bull market, and volatility is a normal element there, something that we do expect to continue to experience over time, and we've been a bit overdue for. And so in the first half of 2024, we saw a little bit of volatility in April, but beyond that, the stock market's really gone up more or less in a straight line since October of 2023. So we've been on a really nice roll. And so, yes, we are likely due for a pullback, a normal correction. And these tend to be healthy over time. As you have a prolonged period of strong market performance, you'll see a lot of stocks and funds and indices get a bit expensive. Prices get a bit above what earnings growth has been. Prices going up too much. And so it is healthy to have these occasional corrections to bring things back in line. When people ask, is this the correction? Are we in the midst of it? How long is that going to be? We do kind of line up, in terms of the seasonal calendar. Generally, if you look at all the months of the year and go back, this chart goes back to 1950, you'll see that August and September are the two worst performing months typically. Remember, every year is different, right? We provided in the past some examples how in election years, usually the year starts out a lot slower. Wasn't the case this year, for example. And you'll note that even in August, which is typically a down month historically, 54% of the time, the majority of the time, the stock market is up. But nonetheless, on the seasonal calendar, these are tend to be softer months that do line up with some of the volatility that we've seen. The good news here is that fourth quarter, October, November, December tend to be very strong. The strongest quarter of the year. And so we'll see how the next couple months line up. But we are in a long bull market. We've been on a nice run going back to the end of 2023, as noted. And so it wouldn't surprise us at all if we do see a correction occur. That brings up the question, what is a correction and what does this mean? Is this something we need to be worried about? Do we need to make changes? And the answer is corrections are very normal. A stock market correction by definition is when the stock market drops by over 10% from high to low, from peak to trough. And as you can see on this chart, which goes back to 1980, the gray bars is where the S&P 500, the stock market, performed for the full calendar year. And the red dots are the biggest drawdown the stock market experienced during those years. And so what you'll note is the majority of the time, 33 out of these 44 years, the stock market ended up and generally up handsomely during the year. And what you'll note is just about every single line as well, there's a red dot that hovers at that 10, 14, 15, even in certain cases like 2022, 20, 25% drop, right? And so on average, every year the stock market experiences one correction. That means a 10% drop in the stock market. That even occurs in most positive years where the market ends up strongly. And so these are really normal occurrences, which, as noted before, can be healthy to keep the market from experiencing too much of an excess at any time. As of early August, so I'm sitting here filming this on Monday, August 5th, coming right off a down day in the market, a couple of down days in a row. The S&P 500 is still down 8.5% of a year from high to low. And so we have not experienced a 10% drop yet, which again, like we noted, we see in most years. And it tends to take a while for these things to sort themselves out. So it's not generally, hey, the market drops a bunch in a week. We got our 10% drop, check, time to pile back into the market. Commonly you'll see the market hit a drop. It may come back a little bit as some investors put in excess cash, may come down again a little bit as it gets its footing. And so this is sort of the normal song and dance, right? But again, to summarize, stock market corrections are normal. Most years we see a 10% drop in the stock market. That's very standard. And despite this, the stock market over this period of time has averaged, north of 10% a year, going all the way back to 1900, close to 10% a year long-term performance for the S&P 500. And so this is sort of part of a normal process to get to those end results that we see. So with this recent market volatility and all this talk of corrections, the question is what has triggered, this recent, pullback in the market? And are we in a recession? Is it going to happen? What's that mean for us? And so, we do think this is something to watch as it's been for a number of years now, right? Despite all the recession calls going all the way back through 2022, we technically have not experienced one yet. Here we are in the summer of 2024. The recent market volatility, one of the main triggers there is that we've seen unemployment rates start to, get up to a higher level and elevate a bit. And that's been a big indicator of a slowing economy. And so, for example, as of August of 2024, the most recent unemployment readings came in at 4.2%, right? The highest level that we've seen since 2021. And so that tends to indicate questions on, does this mean we're seeing a slowing? Are we going to have a recession? Has the Fed waited too long to cut rates? Is it too late? On the flip side of this unemployment number, a lot of the other economic numbers have been very healthy. For example, we've seen a second quarter GDP growth, economic growth, come out to a much higher level than anticipated. We're expecting 2.1% growth, and it ended up at 2.8%, which is a really strong level. And so that tied in with the lower inflation readings that we've seen have shown a lot of resiliency and health on that side. And so I think without a doubt, we are seeing the economy slow a bit, which is expected when you have these prolonged years of elevated interest rates, at 5.5% currently. But at this point, things have still been very resilient and holding on, pretty well, despite some of the headlines and worries that we've seen related to this figure. In addition to, where's the economy, really, in my view, in our view as a firm, company profits, company earnings is really the metric to continue to watch. All this is interrelated, of course, but at the end of the day, when you own stocks, you own companies. And the reason you own companies is those companies are expected to generate profits over time. And so good company economic growth, good earnings growth, good profit growth is really an indicator of longer term returns in our view and something to absolutely track. And so earnings growth has been very solid, similar to GDP economic growth. At this point in the second quarter, we've seen earnings grow over 11% from a prior year, which is a very good number. It's expected that the fourth quarter, we're going to see further earnings growth and even more progress. And so, again, this is a really healthy indicator of a resilient economy despite the higher interest rates and unemployment ticking up. I will note that earnings tends to be a bit more steady. And what that means is the stock market, you'll see 2022 is down 25%. And then, 2023 was up, north of 20%. And then 2024 is up a lot. So you get these large gyrations, right? Earnings tends to be much more steady, where you'll see, oh, it's up 11% or up 8 or 6 or, down 2%, right? And so the stock market does tend to operate on I'd say a much more volatile track around earnings. And so while earnings have been really strong, we have seen the stock market run quite a bit and grow at a faster pace than earnings has, which is another reason, as noted, where these corrections tend to be healthy to put the stock market and prices in line with the underlying profits that those companies are earning. But again, it has been really sound earnings growth as of late, which is a really key indicator for future market performance. So we'd be amiss to not mention a lot of the geopolitical unrest out there, as well as the tension with the elections coming up. And much of the recent volatility can be surrounding this, right? We've seen Biden drop out of the election. Again, the stock market is not a fan of uncertainty. And so, here we are in August dealing with a new, Democratic candidate, right? Is a bit of a curveball. Some may say, but still a change that the market's digesting. On top of that, we continue to see the tensions in the Middle East continue to escalate with the war in Israel. And, that creates a lot of anxiety and uncertainty as well. So these can absolutely be factors that are also leading to the recent volatility that we've seen in the market and one to continue to watch going forward. And so while earnings and the economy are the main drivers of the financial market, it is our role to keep a close eye on other events, including geopolitical risk, election risk, as we proceed forward here. So as we're talking about elections, it is sort of interesting, a caveat that we have seen markets have tended to predict the election pretty well. And what that means is in years in which the incumbent party won, that's that top darker green black line on the top there, the stock market tend to perform well in the months leading up to the election. So that's that gray shaded box you could see the top line really charged ahead leading up to the election. which tends to make sense, right? You have good markets, people are feeling more wealthy, they're feeling better about things as their bank accounts look more full. And that may tend to result in more comfort or a better gauge in terms of a current incumbent party. The lighter green line, the lower one, in years that the incumbent party lost, we saw that the stock market tended to struggle heading into the election. And so this will be an interesting statistic to watch to see if the market again tends to be a predictor of which way the election goes. It's worth noting that this election volatility tends to be very short-lived and quickly tends to give way to an upward moving market once we get through the elections and we know who the next president's going to be, as well as senators as well, for example, and then House members. But nonetheless, this will be interesting to see if the statistic stays true this year. And to piggyback on that, and I know I've shown this chart many times, and our firm has, but markets have tended to do well regardless of party. And so whether it's for Republican or Democrats, there's been 8 Democratic and 7 Republican presidents going back to 1933, so nearly a century ago. The general direction of a market has been always up, right, in both of those cases. And on top of that, we have seen the market do well over both a Trump presidency and a Biden-Harris presidency as well. And so nonetheless, regardless of which way the election goes, history has shown that the market tends to perform strongly once there's a certainty around which direction the elections land. In addition to the presidential race, the other races of Senate and House are ones to really watch, and not necessarily in terms of the market impact, but more of the tax impact. As you can see on this chart, markets have tended to perform very similarly, whether you have a unified government. Going back to 1933, a unified government has averaged a 14.4% annual return in the S&P 500. If you have a unified Congress and a president and another party, the markets have averaged 11.7% a year, still a really strong number. And if you have a split Congress, the markets have averaged 13.7% a year. And so either one of these, right, investors would sign me up. These are all very good outcomes going back the last nearly 100 years. As I mentioned, though, in the title of the slide, we can see a lot of tax impact, especially this year, based on how these legislative races go. And specifically, if we see a split Congress or a Democratic president, there's a good chance we're going to see tax rates sunset and the current Trump taxes that we still have in place sunset to what we had before Trump's last term. Which in many cases will be some tax rate increases. You will be able to deduct, more taxes. For those that have a state income tax, for example, that might result in some tax savings there. Likely for us to continue the current tax rates, we'll likely need a Republican sweep. Otherwise, we'll need parties to get along to see tax rates be extended. So I wouldn't hold my breath on that one, right? But this is something that we're going to watch very closely as we get up into the elections, and will help dictate a lot of tax strategies that we plan to implement for clients based on where these outcomes land. So again, we expect markets to likely do well over the long term, no matter the outcome. Taxes, though, could be a different story. So it's something we're really going to watch heading into the elections. One more slide I wanted to share is I've been noticing more and more headlines on stagflation as of late. And so that brings up the question is, what is stagflation? Stagflation, which has a really negative connotation, and rightfully so, is basically where we go through a period of slow economic growth, high unemployment rates, and increased inflation. And this can be a very precarious situation, especially for policymakers, where there's not a lot you can do, where anything you want to do to support the economy tends to be inflationary. And so this was a real worry in 2022 when we saw inflation rates nearing 10%. For the record, Fed Chair Powell is confident that we are not going to be in a state of stagflation. And he has made comments that he doesn't expect the stag, so the economic slowdown, nor inflation, based on where things sit right now. And let's absolutely hope that's the case. It's been really positive seeing inflation come down and economic growth stay resilient. But this is something to watch, especially I'd say given the current government deficit that we have and the debt load. Next time that we need to do sizable stimulus, like we saw in 2020, that may potentially push over the edge into one of these scenarios, for example. And so again, we're not in a stagflation environment right now, but this is someone to be mindful of in a really tricky environment for investors. And I will add that there's always concern that tariffs can especially add to this environment where you see inflation from tariffs, right, as you're adding the cost of goods coming into the country. And then that also can potentially lead to a slowdown in the economy if you see other countries try to retaliate in that regard. So one to watch going forward, but in our view, not something in the near term that we need to be too worried about. Okay, so to sort of sum it all up, we're going through some market volatility. These periods are common and they do happen. We'll see how long this current bout goes for, but just about every year you see a 10% pullback in the markets. While there are absolutely some signs of the economy slowing down, there are also a lot of positive signs around company profits being strong, inflation coming down and showing a lot of progress in that regard, and then GDP growth being very resilient. And so those are all good things in that regard, of course. You do have to layer on the geopolitical risk and tensions and election uncertainty. And so nonetheless, we could absolutely see a lot of volatility here leading up to the election. And so just something to be prepared for and just know it's part of the experience. And the real key for all of our clients is we believe in being proactive, having a strong financial plan for all of our clients to weather these periods. And if at any point you feel nervous about the markets or uncertain or want to review that plan with us, please contact us anytime. That's what we're here for on top of our regular reviews. And so key takeaways, we saw the second quarter close out a really solid first half of the year. The Fed funds rate has remained at 5.25% to 5.5%. No rate cuts yet, despite the early expectations for 7 rate cuts this year. We've seen interest rates start to come down outside of a short term. Still having an inverted yield curve going on 2 years, but starting to flatten. And after a strong first half of the year, we are seeing some recent market volatility, which candidly we were likely due for. It's expected the Fed will deliver a rate cut in September, so we'll be watching that closely. And again, stay the course, focus on the long term. We expect that we're going to have periods of volatility. It is normal. They're going to happen. We're going to have more of them. And the key is having a course to get through those periods, which is we really focus on and take pride in and being well prepared in that regard. And so thank you for tuning in. We appreciate you. As noted, we are here for you, so do not hesitate to pick up the phone and call us if you have any changes to your life or questions or read something that's giving you anxiety or uncertainty. Also wanted to put out there, we appreciate all those that have joined our Client Ambassador Club. We had an amazing event earlier this year, thanking those that have introduced us to people that they care about, that they think may benefit from our services. In addition to introducing us to someone that we meet with, bring a friend, family member, someone that you think would be good to meet us to one of our client educational events. We're going to have another one this fall on the tax sunset, so looking forward to that. And so a big thank you here. And I do want to know, as we're going through uncertain times like this, it is so important to have a good team on it and good advice, which we really focus on and put a lot of pride in doing for our clients. And so if for somebody that you care about, you feel like is not getting that advice, please make an introduction. We'd love to talk with them and see if we could be of help. So thank you so much for tuning in. We will talk to you all soon, and please do not hesitate to reach out with any questions. Take care and enjoy the rest of your summer. Thanks.